Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more educational content like this, please visit the resource library at adisa.org. My name is Greg Mausz. I'll be your host today. I'm joined by Michael Underhill. He is the Chief Investment Officer at Capital Innovations, and we're going to be talking about infrastructure investing. So thank you for joining me.
Pleasure to be here.
So why don't we start with the fundamentals? Walk me through what is infrastructure investing.
So infrastructure investing, it's really become its own asset class, at least in the United States over the last 10 to 15 years. When people look at infrastructure, there's really a legacy asset class. So think airports, seaports, toll roads, traditional energy like pipelines, oil and gas, and then you have newer types of infrastructure industries. So think data centers, the cell phone towers, even industrial logistics warehouses that are supplying some of the storage facilities for some of the large e-commerce companies. So you have legacy infrastructure and newer industries that are really complementing the old line businesses, providing a large universe of investment opportunities.
So I've been around the investment industry for a while. You haven't heard a lot about infrastructure investing until recently. So is this really a new asset class or just new terminology? Can you walk me through that?
Yeah, I think it's not new terminology. I think it's new for the United States. Admittedly, infrastructure as an asset class, it became its own asset class probably 25, almost 30 years ago in Australia under Prime Minister Kennett. When you look at some of their fiscal deficit issues, they were faced with some of the similar problems we have today with the government's inability to fund critical infrastructure projects. Under Margaret Thatcher in the UK, same thing, 2+ decades ago. What did they do? They actually issued equity and debt on public exchanges, and that providing a critical financing mechanism so they could finance their airports, seaports, toll roads, water and wastewater treatment facilities, so critical essential services. We're getting financing structures from public markets as well as private markets, so think private equity and private debt funds, as well as pension funds invested in those asset classes, again in Australia and in the United Kingdom. Just recently in the last 10 to 15 years in the United States, infrastructure has become a more viable asset class and a more viable financing mechanism for some of these essential services here in the US.
Thank you for walking us through that. That makes complete sense. So what is really attracting investors to infrastructure these days?
I think it's a combination of things, right? It's an incredibly low interest rate environment. Quantitative easing part 3, if you will. I think when you look at monetary policy pre-COVID, it was artificially suppressed rates, very accommodative monetary policy. We went through, admittedly, a global economic catastrophe, a shutdown due to COVID. US government stepped in, provide trillions of dollars of more additional quantitative easing. So you've got a yield compression. Investors worldwide are searching for yield as well as capital appreciation, and now they're faced with the challenge of investing in publicly traded equities, publicly traded bonds, at a time when risks are at an all-time high in the equity markets, yields are at all-time lows in the fixed income markets. Infrastructure provides not only capital appreciation and yield, but a low degree of correlation to stocks and bonds, and provides essential services. So I tell everyone, whether you're in a financial recession or depression, people continue to flush their toilets and take showers, at least we hope they would, right? So they invest in these critical asset classes to provide income, capital appreciation, and diversification, long-term return enhancement.
So you were just comparing and contrasting there. Is the yield that much better on infrastructure investments than some of the other, like bonds and equities that you mentioned?
It is, and it's even more nuanced by subsector. In other words, water and wastewater treatment facilities, you're seeing 5% and 6% yields. Energy and alternative energy, you're seeing 6%, 7%, 8% yields. Transportation assets and even some of the communication assets, so think data centers and cell phone towers, you're seeing somewhere between 7% and 8%, maybe even 9% yields on some of these assets. So you're getting a significant yield increase, and the underlying assets, the cash flow, is paying the yield, so it's not artificially enhanced yield. And so these assets are generating cash flow daily, weekly, monthly, as well as inflation protection through inflation escalators. So you're getting a yield enhancement, not through leverage, not through financial engineering, but through the organic growth of the asset dividend and the actual underlying payment or user payment streams.
Okay, I like that. So you've sold me on it. What is the best way to access infrastructure investing for investors and for advisors for them to try to navigate this market?
Yeah, so that's the $50,000 question. And whether you're a retail investor, an institutional investor, a sovereign wealth fund, there's a whole multitude or a typology matrix of investments. And you've got publicly traded on one side, you've got private market investments on the other side. In the publicly traded side, you can invest in stocks and bonds, so think municipal debt, infrastructure debt. Publicly traded equity, so you can invest directly in a company like NextEra, which is one of the largest solar utilities in the United States. Admittedly, if you want something that's professionally managed or a packaged product, you can invest in a 40 Act mutual fund that's actively managed. You have something like the S&P Global Listed Infrastructure Index, which is a passive exposure, as well as you have exchange-traded funds, of which there's 2 to almost 3 dozen global listed infrastructure exchange-traded funds. In the private markets, you have both equity and debt. You can invest in not only funds, but you can also invest in different types of direct investments. So think private placements. And now you're starting to see, that was 1.0, we're now just starting to see 2.0, where you have hybrid capital structures, things like interval funds, that you can access infrastructure both publicly traded and private. So you have safety, liquidity, and yield, and you have a blended liquidity profile, so you can manage through a March 2020 COVID event, and a fund manager may be able to tactically take advantage of some of the arbitrage in the marketplace.
That's great that there's so many different options for investors and their advisors. Now, could you walk me through maybe a few of the pros and cons of those different structures?
Yeah, so when you look at pros and cons for private markets, you've got obvious illiquidity issues, right? Whether it's private equity, private debt. You've got valuation issues. Are the valuations struck pretty much quarterly or semi-annually, sometimes annually? You have better control, you have better corporate governance in the sense you have GPs that have skin in the game, capital at risk, their own partner risk, capital that's invested in the fund. And I think what you're seeing is more of a control and a longer investment time horizon, 10 plus years, in a private equity or private debt infrastructure fund. In a project, again, longer term, higher degree of control, concentration risk as you're taking a quote unquote bet on one project as opposed to a pooled fund of 10 or 15 projects, right? So there's always sort of pros and cons to risk and return. The more the concentration, the higher risk, but the higher the potential return. Conversely, in public markets, again, you look at single stock investment, buying again NextEra Energy, it's a solar utility. You're getting yield, you're getting capital appreciation, albeit modest. In a utility, you can invest in something like an alternative energy battery company. You look at a company like Enphase, it's in the supply chain for energy materials for renewable energy. That's going to have a little bit higher volatility profile, a little bit higher beta. Again, these are more passive investments, investing in public markets. And again, if you were to then diversify away from a single stock investment into an ETF or a mutual fund, you're getting professional management, or at least a methodology in an ETF, professional management in a mutual fund or an interval fund, and you get a diversified pool of opportunities that's being managed and measured on a daily, weekly, and monthly basis.
Perfect. And there's also tax advantages that you can probably incorporate into those pros and cons. Different vehicles have different methodologies there.
You've hit the nail right on the head. I mentioned risk and return typology. I haven't even touched upon taxation, and that's probably a whole nother video we can shoot on taxation and the benefits of tax management within this asset.
Well, let's not go there. Let's stay at a higher level. And so somebody's interested in allocating to infrastructure. What are the key things that an investor or an advisor needs to consider when making an allocation to infrastructure?
Yeah, so again, great question. When I look at the institutional marketplace, which really has led infrastructure investment over the last 20 some odd years, overseas and the last 15 years here in the US, it's a combination of top-down, what is infrastructure? How do you access it through public and private markets? How do you benchmark it? And then from there, what is the outlook, i.e. from an economic perspective, are you investing in GDP, economically sensitive assets, economically insensitive assets? A good example, economically sensitive assets, energy. Economically insensitive assets, think water and wastewater treatment. And then from there, building a program that's diversified globally by sector and country and currency, and selecting an appropriate benchmark. From that point, the institutional consultant, broker, advisor then takes a program or an investment and says, okay, what's the appropriate allocation amount? Is it 1%, 3%, 5%? Again, if we look at the institutional milieu, where you have the CalPERS, Texas teachers, Cornell University, endowments, foundations, and public funds, even sovereign wealth funds, they're investing as little as 5% in infrastructure. to as much as 25% if you look at some of the more astute investors that have been doing this over multiple cycles.
Wow. Well, Michael, thank you for walking us through kind of those fundamentals and a little bit of deeper dive on infrastructure investing.
That's my pleasure, Greg.
And thank you for watching another episode of Focus on Alternatives. For more videos and educational content, please visit adisa.org. Thank you.